Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. We are on part 3 of the video series discussing the cost aspect of getting a reverse mortgage. And in this video, we're going to pick up where we left off, which was answering the bottom half of the questions that are left remaining, which is dealing with how is the reverse mortgage going to charge for the mortgage insurance protection? When is it paid for and by whom is it paid for? Why don't I have it right now, in the sense that if you have a traditional mortgage, why don't you have mortgage insurance premium if it's so good? And when is it going to be used for my benefit, and the alternatives to getting a reverse mortgage? That will leave unanswered the question of how much is it, because this question of how much is it is a formula that I need to rule out and put out, and I want to make sure that that has its own specific topic. But this is the format that you've seen in the past two videos that we've talked about, and we broke it down and we said why a reverse mortgage has the mortgage insurance premium, and I likened it to the most common thing that I think you as a senior or someone that has had a home and has had mandatory insurance are familiar with, and that's likening the mortgage insurance premium, the MIP, to the idea of going to State Farm and getting a homeowner's insurance protection policy, and understanding that through your relationship with the lender, you're supposed to be protecting yourself and the bank's collateral against future damage, which could be through for you, it's fire, theft, damage like water loss, personal injury, lawsuit if something happens on your property. And for the lender, it has to do with fire and damage. But what you specifically know is that State Farm is not going to be able to protect you, not just State Farm, frankly, and any insurance company that you go a traditional homeowner's insurance policy for is not going to be able to protect you against what? Well, they're not going to be able to protect you against potential property value depreciation, home wealth equity loss. That's beyond the course of what they can do. And what happened in 2008, 2009, we discussed, is that there was a significant depreciation of property values. And these were people that had homes that conceivably were less in terms of value when these homes were sold than how much they owed on their mortgage. So you had someone that had a $900,000 mortgage, but their property value, if they were selling it in a forced short sale, was $800,000. So they were upside down. And that short sale allowed the lender to come after the borrower for what? A deficiency judgment. And we said when you get into a reverse mortgage, because of the legal ability of the borrower to not have to pay a mandatory monthly mortgage payment for as long as they live in the property and as long as their spouse lives in the property, while they obviously have to have this insurance and protect their home against theft, fire, and things of that nature, they also need to have something in place to protect the lender in case of another situation where, through their non-monthly mortgage payment and property values depreciating, the lender would be protected. And I liken the MIP to being the backbone of the reason that the reverse mortgage is even available. In other words, the reason the bank is willing to lend and let the senior not have to make a monthly mortgage payment is because of its assurance through the FHA that there's a mortgage insurance premium in place. Now, that big ticket item that you get when you get a reverse mortgage, that is not a lender fee in the sense that it's not going to the bank. The bank is giving it to the FHA, and the FHA is buying insurance on your particular reverse mortgage through the Mutual Mortgage Insurance Fund. And this Mutual Mortgage Insurance Fund is protecting the lender against depreciation of property values and you not having to pay monthly mortgage payment. But it's also protecting the senior, their estate, as well as the heirs of the senior, because it becomes so that a reverse mortgage is a non-recourse loan. And a non-recourse loan means that there cannot be any deficiency judgment. What the lender was able to get over here, which was a deficiency judgment against the borrowers, there is no deficiency judgment against the senior or their estate or their heirs through a reverse mortgage, even in the case of a short sale. Now, the answers we want to have to the questions that we raised on the other side is, well, how is it paid for? How is this MIP paid for? And when is it paid for? And my contention is that unlike the traditional mortgage insurance payment that you have here, in the sense that you get to State Farm and you have to pay a $1,500 yearly fee to have your insurance going, you don't have that cost with the MIP. It's not an out-of-pocket payment. And the way I can explain it to you is that given how long you've had your home, when you think back about how much you purchased your house for 20, 30, 40 years ago, you may have bought the house for $200,000 and now you know the property is worth $1 million. That housing wealth, that housing appreciation is your housing wealth growth. That's not how much you pay down your mortgage with. So the way I could explain it in terms of the most easiest to associate with is that we're taking a small fraction of your housing wealth growth or housing wealth appreciation and using it to purchase this mutual mortgage insurance fund. Now, the other question is in terms of why don't I have it now? Well, the reason you don't have it now is because you don't have a reverse mortgage. And under the mortgage that you do now have, which is a traditional mortgage, you have a different contractual obligation with the lender. And I keep going back to this idea that there's a triangle. There's the lender, who's the bank, there's you, who's the borrower, and then there's the home, which is the collateral. Your relationship with the lender is twofold. You're obligated to pay the mandatory monthly mortgage payments, property taxes, the homeowner's insurance that we have here, and to maintain the property. And the bank also has a collateral interest against the property, which is its security interest, and it does that through a lien, through a deed of trust. Now, with the traditional mortgage, which is what you're used to a scenario where you go and you borrow $400,000 loan amount from the bank and you say, I want to get a 30-year fix. And when you get this loan, however young you are, however old you are, you understand basically that during the course of the next 30 years, you're going to be paying monthly mortgage payments. And because of your relationship of making monthly mortgage payments, minimally, this loan amount is coming down so that by the time you reach 30 years, the loan balance is reached zero. But what else has happened? Well, your property values has gone up significantly because over this 30 years that you've had this house, I always contend that you've never maintained this property in terms of keeping it as long as you've had the same loan. You've had opportunities where the interest rates came down and property values came up and you refinanced. And every time you refinance, you basically started a new relationship with the bank and going another 30 years. So what has the bank known? Well, the bank has known that you're working, your employment income is significant, you have a lot of years of working ahead of you. And if you see my video that I've done regarding what the bank qualification guidelines are and my contention of why you won't be able to qualify for another traditional mortgage when you're in your retirement as a senior, you really see a breakdown of what the underwriting guidelines are. And that's why I contend that when you're in your 70s or in your 80s, even if you have an 800 FICO score, if you have a property that's worth $1 million and it has zero amount owed on it on a mortgage, you're not going to be able to come in and get a $400,000 loan because your income employment is non-existent. you don't have income from your employment anymore. You traditionally just have income in the sense of Social Security, maybe a pension. So the rule is that you're not going to qualify. Now, are there the exceptions of some people that may have enough income coming in that they can? Yes. But then the question becomes, do you want to be 80 years old and making monthly mortgage payments on a house that's worth $1 million and you're borrowing $300,000 from? And that's what we keep going back to, that there's an alternative where you're not required to make mandatory monthly mortgage payments because you're on a fixed monthly income. And what happens if you lose your spouse's income? What happens if you need to stay in this house and you need to draw your savings or your reserves in order to pay this monthly mortgage payment? But the crux of why you don't have MIP in place here is because the bank, in its underwriting guideline, felt comfortable that given the reserves that you have when they approved you for the loan, given the fact that you were working, given the fact that you're able to meet your credit obligations, you're going to continue making this monthly payment so that over time, with the property value appreciating and the loan balance coming down, everything is going to be okay. Now, what happens in a reverse mortgage situation? Well, in a reverse mortgage situation, you have a significantly smaller loan amount or your property is free and clear, okay? And here I have the age spectrum. So I have an age spectrum in the bottom, starting at age 62, which is the starting age where a senior can get a reverse mortgage, going up to an age 100. Now, I don't mean to imply that somebody's going to come in at age 95 and get a reverse mortgage to 100, but I want to show a glide path of how long a potential person can stay in their home and not have a problem. And because the starting age is 62, so the question becomes, if this person, let's say the husband is age 62 and the wife is age 59, well, we're going to do the loan based on the wife's age, who's 59, but because she's married to someone who's 62, then she gets grandfathered in, or she gets included into the reverse mortgage. But if both spouses are 62, then obviously it's not a problem. I just wanted to address this in case you're thinking, well, my spouse is younger than I am, how's that going to work out? That's not a problem. You're age 62, she's younger. We're going to do it based on her age in terms of the determining factors of determining the loan amount, which is property value, interest rate, and the age of the youngest borrower. Now, the other side of it, what we have here is the property. And I have a property that I say it's $1 million here. Okay, so we have $1 million property and I have it at 90%, 80%. So these are loan to value. So this is the LTV that you're most familiar with the idea of LTV. So the reason we're getting the mortgage insurance is because the bank knows that, let's say you're getting the mortgage at age 75. And you have a property that's worth $1 million, you're age 75, and let's say we say that you get 50% of the property value, which is, let's say, $500,000. Well, the bank knows that if you get access to $500,000, you also don't have the option in the sense that it's mandatory. You have an option now to pay the payment if you want to, but you don't have to make the payment because it's no longer mandatory. So the issue becomes, if you choose not to pay monthly mortgage payments and you borrow some of this money, or some of this money is used to pay off your existing loan. So for example, let's say this borrower has a $200,000 mortgage in place and he gets a reverse mortgage to pay off this $200,000. Well, if he does what is intended with the reverse mortgage, which is not be obligated to make mandatory monthly mortgage payments, what's going to happen is these payments that he should have been paying and not paying are going to increase. Now, this line that I'm making is very drastic because the balance doesn't rise at this level. But I'm making it so that it's visible and it's dramatic in the sense that to make my point. So if, let's say, for example, in the next 20 years, in other words, he's 75 here and this is 95 and he's lived in this house for 20 years and he hasn't made a mortgage payment, well, what happens? Let's say this has doubled. So now, because he hasn't made mortgage payments for 20 years, the balance has risen from $200,000 to $400,000. Now, on this other side, we have the property values, and then the question becomes, what's been going on with the property values? In other words, when we gave him this mortgage back here, where we paid off his previous Bank of America loan for $200,000, we appraised the property at $1 million. Now he's 95, he's moved out of the house, or he's passed away, and they want to sell the property. Well, one scenario is the property values over the past 20 years have grown, and now the property has gone from 1 million to 1.5 million. Well, if the property has gone to 1.5 million and he now owes $400,000, well, his estate will just come in, sell the property, and say they sell the property for 1.5 million. There's $400,000 owed to the bank. They pay the money to the bank, and after they back out the commissions and the fees for the realtors and everything else, they walk away. Figure they walk away from selling the property at 1.5 less the $400,000. To make the math simple, let's just say 1.1, and they'll back out the commissions and everything out of it. My point is that there was a $200,000 loan, which over a 20-year period grew to $400,000. Property value appreciated to 1.5. So there's no negative amortization, in the sense that there is negative amortization, there's balance increased, but there's no amount of property value decline. Property continued to grow. Now let's say there's another example. Let's say in this other example, this person comes in and he gets $400,000. And over the same 20 years, this $400,000 becomes $800,000. It doubles. And let's say in this case, case number 2, the property value, which was $1 million, we're going through a really bad time in the market, and this, what used to be a $1 million house, has plummeted and is now worth $700,000. So in this case, where the property value is less than how much is the current balance, there's an upside down, there's a deficiency. There's this situation where previously the lender could go and get a deficiency judgment. Well, in this case, what has happened is that property values have gone down. Nobody could have foreseen it coming. The senior got to live in this house for 20 years, borrowed the money, not have to make monthly mortgage payments for the 20 years, but because of unforeseen reason, property values came down, so there's a $100,000 shortfall. So what's going to happen? Well, they're going to sell the property, or they could just simply walk away from it, and the lender is going to be perfectly fine, because a reverse mortgage is a non-recourse loan. And a recourse is the fact that in this case, the bank could go after the estate or the senior with a deficiency judgment through a short sale, but through a non-recourse loan, which is what a reverse mortgage is, there is no deficiency judgment allowed to the lender. So this $100,000 loss that the lender, is looking at, where does that get recovered from? It gets recovered from the FHA purchased mutual mortgage insurance fund. That's in essence the MIP at work. The MIP only kicks in and is only required, or its protection only kicks in when there is an inverse relationship between property values going down, where their property value is less than the current mortgage balance. And if in the other scenario, in example number 1 that we talked about, where property value has gone up to 1.5 and this balance has grown from $200,000 to $400,000, there is no reason for the mortgage insurance to kick in, because there's sufficient equity here. But in scenario number 2, because the starting balance was significantly higher and the person stayed in for 20 years, and because of that larger balance, you had a larger payoff, and because of unforeseen real estate factors, the property declined significantly, then there was a situation where the lender was upside down. And because the lender was upside down, in this scenario over here, the lender could have gone over and pursued the senior or the estate. But in this instance, with the reverse mortgage, because of the non-recourse, because of the mutual mortgage insurance fund being in place, and because of the mortgage insurance protection being FHA required, then there was no legal exposure to the family. So this is the benefit and the reason I say that the MIP is the backbone and the reason that the lenders are engaging in the reverse mortgage and are okay with the scenario where for the time that you're living in the property, you're not making a monthly mortgage payment, because clearly here the monthly mortgage payment is required and continued and ongoing. But here what we did is we paid off this mortgage wherever it was, and then the person got to stay in this property for another 20 years and not have to make a payment. And regardless of what happened to the property values, whether they went up or they were down, they didn't have to make a payment, but they were also protected. If the property values went up, it would be just like a traditional sale, and they would keep the reserve and the balance of the sale. But if the property values went down significantly, they were okay, and there was a non-recourse loan. So with this third video, the biggest question is, well, when we're talking about this MIP, and I understand that part of it is coming from, or all of it is coming from, part of my housing wealth appreciation, what is the cost? And that requires a formula, that requires a little bit more math, and that requires a whole clean board that I will do on the next video. But for this video, I wanted to just pick this up and explain it so that we have it. We now know why it's used, how it's used, who does it benefit, how does it benefit, and whether it's applicable in terms of every time. Every time there is a sale of a property, unless and until you're in a situation where the property value is below what the current balance is, you don't need to have the mortgage insurance premium conversation. All right, I will see you on the next video. Thank you for being my client. Have a beautiful and blessed day. And the next video will cover the math and the formula used to calculate the MIP. God bless you. Thank you.